Next 12 months to me, if I were to condense it down to one sentence for multifamily, I would say steadily increasing opportunity. Not a tsunami, not a crash. Something that I saw a couple of weeks ago that would be unfathomable for you and I to discuss 2 years ago was we saw a lender approved short sale on an apartment complex. And this was a B asset in a high income market in the Carolinas.
Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. We're back. We have another amazing guest. My job is to get the best guests on this program. My team and I try our best to do so. And today we have Andrew Cushman. Andrew, thank you for being here.
Yeah, good to be here. Appreciate it.
For sure. Vantage Point Acquisitions. I read your bio. If you can catch me up to speed, tell me your story, and then we can talk about the big stuff. Hit me.
Started as an entrepreneur when I was 5, raking yards and playing Monopoly with my grandfather. Got a chemical engineering degree in college because I just figured, well, that'll pay the bills until I discovered my real calling, which was flipping houses in Southern California in 2007. My wife and I and my business partner, we flipped a house. I walked into my engineering job, quit right as the great financial crisis started. Figured that's going to be the best time because I'll have no competition. Worked out great. And then we had some really good years. And then in 2010, we said, this has been good, but it doesn't create wealth. You're only as good as your last flip, right? You put a check in the bank and you're done. You get nothing to show for it. What lasts longer? What creates more wealth, more income? And where's the economy going? Well, we said, okay, everyone just got foreclosed on and can't buy a house for the next 7 years. The people who didn't get foreclosed on are scared to buy a house for the next 7 years. And we had a huge crash, which means we're probably going to have an extended period of economic growth. So we said, all right, so economic growth means jobs, household formation, no one can buy. That's going to make for a big renter pool. And so we said, let's go do apartments. We syndicated our first one in 2011, 92 units out in Macon, Georgia. I don't prefer that market these days, but it got us started.
That's a big first deal.
Yeah. Well, things were a lot cheaper back then. We paid like $7,500 a unit. Since then, we've done a little over 2,700 units. We focus on the Southeast United States, B to A minus, and it's been a great business for us and the investors. We've enjoyed it.
That is incredible. That's a big jump. Let's back up for a second. So that many units, that many properties, that many states. What type of investors do you have? Are they accredited, non-accredited? Can you share some of that?
Every investment opportunity we've done has been 506B, which means we don't advertise, we don't solicit, I don't post it on LinkedIn or Facebook.
Wow.
You have to already know us, right? And part of the reason is the sophisticated, non-accredited investors, they were the ones willing to bet on us on that first crazy deal. And we want to still give them opportunity to continue investing with us. Our investor pool is about 85% accredited and about 15% sophisticated. And that's about the split. So the majority are.
That's amazing. Kudos to you. It is a tough industry, and you always got to keep the coal in the engine after you get it going. So here, let's just say the last year and a half has been a little bit nutty after amassing that many responsibilities. How have you guys been able to function? How has it been for you, our investors? I get a lot of questions, and I'm always trying to reassure people, but would love to hear from you.
We're actually doing pretty well, not because we saw this coming, but because, as an engineer who took a lot of math and calculus, I tend to do things based on the probabilities and probable outcomes. And then I define hazard as risk times probability. When we did deals in 2021, when interest rates were super low, we looked and said, well, what happens if interest rates go up a bunch in the future? And we're not sure that looks probable, but if it does, it could blow these things up. And so we fixed our interest rates. Not because we saw this coming, but we saw if a huge increase in interest rates happens, it could cause a lot of problems. We've got properties where we have 12-year agency debt at 3.79%, and it's fixed. And so, because of that, our portfolio is actually in great shape.
That's incredible, man. What you're describing is like a lot of the horror stories you hear here and there. No one wants to say, hey, in private equity, there's managers and operators that made big, foul mistakes that are leading to capital calls and not having returns. So dive into that more. Being a good operator is a big deal. That's huge that you've kept everyone happy and running.
Well, yeah. So what that led to is 2023, 12 years of us operating, we distributed more in operational profits to investors in 2023 than any previous year. So it was a record year for us because operationally, the fundamentals of the rental market are largely pretty strong still. They're still intact. The stress in multifamily almost all on the debt side. And so if you don't have that problem, 2023 was actually a pretty good year. And again, it's not because we predicted this or saw it coming. We just said, well, what is the outlier risk that could blow us up? And we said, well, interest rates changing. And so we eliminated that to as much as we could. Now, the downside of that is we didn't do very many deals. We were only averaging 2 to 3 per year during that period because we couldn't compete with everybody who was getting floating rate debt at 2.5 or 3%. And I kind of look back, my earliest mentor in multifamily, one of the things he used to say is the right deal will change your life. The wrong one will make you wish you didn't have. Or another way to put it is it's better to regret the deal you didn't do than to regret the deal you did do. I mean, there's so many mornings and I woke up like, okay, are we doing something wrong? How come everyone's able to buy all these things and like we're doing 2 or 3 a year? Now I look back, I'm like, oh man, I was so glad so glad we did that and it worked out because we haven't been able to buy much this year because of the huge bid ask spread, but we have plenty of cash to pay our bills and to operate and still be profitable. So we've taken that time to try to add people to the team, to improve systems, and to get ready for what I think will be the opportunity to ramp up acquisitions this year.
Thank you for that. Awesome explanation. I'm going to try to pull out a point though. You probably looked at a lot of deals and probably said no to, I mean, I don't know, 100, 200 deals. Like, how are you penciling?
Last year, we looked at 478 deals and bought one.
Woo-wee! Those are some good numbers. You know what? That is something to brag about as a fund manager. I'm actually newer to this industry. I've been in real estate development for years. And now I'm like, man, it's like a home run when I hear that people are making returns and they're averaging above a 10%. They've made their pref and what you're talking about. These are big things.
Yeah, and unfortunately, not as common these days. So.
Yeah. Here, so let's bring it right now. Where are you? What states are you in again exactly?
So I live in Southern California, but my philosophy is live where you enjoy living and invest where you get the best returns. So for me, that is not California for a lot of reasons that have been well discussed in other venues. But we focus on north half of Florida, Georgia, the Carolinas, Eastern Tennessee, and select submarkets of Alabama.
Amazing. Widespread. Being an engineer probably helps a lot. You're over engineering things, so you don't have any issues. You probably have a good team that's micromanaging. Can you talk about that? How you do it from a distance?
That actually, people sometimes say, well, what is your competitive advantage or what's your superpower? And for us as a team, I say definitely one of them is the way we do kind of a hybrid asset management. So we use third party property management. They cover the day to day, hey, the lady in 3C is late and the dog in 5B bit the guy in 5A. They handle all that kind of stuff. And they've been our management partner since day one. So we've got a decade plus relationship going on now. And they handle the day to day, but we are very intimately involved with every team member on site, the regionals in providing the vision, the direction for the property. We do weekly team calls on Zoom with us, and we include the maintenance people. A lot of times it's like owners will talk to the property manager, and the maintenance guy's he doesn't know who he's working for. We include them, and part of what I found, the interesting thing is, number one, if you go to our properties and you talk to a maintenance supervisor or manager, say, who do you work for? They're gonna say, oh, Andrew and Kelly. They're not even going to say the management company that technically is the one that they work for. And then the other thing too is when you have every aspect of the multifamily team on a call, you end up with the truth, because one person can get on the phone and package things up nicely and give you what they think you want to hear. But when you've got the manager, the leasing person, the maintenance tech, the maintenance supervisor, somebody is going to just say something, especially if you get good at learning to ask the right questions. And so by having that very integrated hands-on asset management approach, that's our strategic edge. And one of the things that we're best at, and other groups are better at other things than we are, but that's our competitive edge. And that's
I
what's
love it.
allowed us to manage from a distance. If you notice, the states that I mentioned are contiguous, right? We're not in Florida, Arizona, Utah, and all these where it's a hard to have efficiencies and scales. I can fly to Atlanta and be to any property we own within 6 hour drive.
Bravo. Yeah, that's a good part of micromanaging and being a fund manager, like where are all your eggs and keeping them in place. With some of the opportunities that are coming up, I know a lot of people use the word dry powder, and people are just waiting to go scoop a bunch of things up. I haven't really seen that too much yet. Have you seen that in some of the places that you're looking? And just one other tidbit, when you're looking at a few hundred deals like you looked at and penciled out, are they neighbors to the current properties? Are they, something a property manager brings you, a realtor? Get into it.
Yeah, so in terms of dry powder, it's funny you mentioned. I just posted this on LinkedIn a few days ago. I pulled the chart from the St. Louis Federal Reserve, and the amount of money in money market funds the last few years, since I think about 2020, has increased from about 3 trillion to 6.14 trillion dollars. That is larger than the world's third largest economy in terms of GDP, which is Japan. Japan's economy is like 4.2 trillion. The amount of money, cash, sitting in money market in the US is 150% of that, right?
That's crazy.
So why? Well, because you can park money in there and get 5%. As interest rates come back down, I don't think we're going to see zero again or anything like that, but they'll come back down to some degree. Those money market funds will be less and less appealing, and the higher yields that can be achieved in other asset classes, such as real estate, will become more appealing. So just reverting to the mean says there's $3 trillion in those money market accounts that's going to come back to alternative assets such as real estate. That's just one way to measure some of the dry powder. It also gives you a scope of just how much money the US government printed and put into the system. Like that's where that 3 trillion came from. It didn't
Yeah.
just, like the government materialized it out of thin air, but other than that, it came from somewhere. So tons of dry powder. A side note, I believe that is one of the reasons that, at least for multifamily, we've probably already seen as much price decline as we're going to see.
Really?
Yeah, prices are down depending on the class in the market, 25 to maybe 35%. And here's why I believe it, without a significant shift in the economy or something, that's probably it. Because number one, operational fundamentals are still strong. Yes, there's some challenges with expenses and all that, but third of our properties set all-time records in December, and the rest of
Wow.
it is still close to that, right? So operationally, things are good. So what has driven the price declines? It hasn't been operations, it's been interest rates. Buyers are like, well, my interest rate doubled, so I have to pay you less. As long as interest rates don't rise significantly from here, that is the biggest lever that has driven the price decline. And if that lever goes away, then I think price declines are largely over. And then the second gets back to what you asked about, that 3 trillion in dry powder. Right now is a chance to get a first mover advantage and snap up a few deals before market sentiment shifts and the stoplight goes green. Now your dollar is competing with 3 trillion of its best friends to get
Yeah.
those deals. 2024, maybe into 2025, great opportunity to buy. And then anything that you buy well and operate well in the next 18 months, if you still own that in 27 and 28, I think you're going to be feeling really good about what you bought. And then in terms of deal sources, it kind of shifts. About 80% of what we've bought in the last 5 years was off market through brokers. We tried doing some direct to seller type stuff, but what we found is we were putting our broker relationships at risk because the owner would be like, hey, these guys reached out to me. They'd tell the broker, and then then we'd be talking to the broker and be like, hey, the seller said, this guy's owner said you reached out to him directly. Like, all right, let's not do that.
Yeah.
And the brokers spend their lives building relationships with owners. So why not leverage that and let them get a piece of the pie too? So we almost exclusively work through brokers. Historically, again, 80% of our acquisitions have been off market. Now we will pick a market and say, we like these 7 properties, and then go to a broker and say, hey, do you have a relationship with these guys? Can you put us in touch and see if we can get a deal done? We do that instead of waiting for it to come to market. An interesting shift we've seen lately is it used to be off market deals were the way to go because instead of 37 bids, you had 5 bids. So you had a better chance of getting a deal. It seems like that's kind of shifted where off market and on market are pretty similar. My guess as to the reason of that is the brokers have learned that, they can't, well, they know this, but a lot of times the off market sellers aren't real sellers. They're just testing the market or seeing if they can get the price that they would have gotten in the first quarter of 2022. Where a listed marketed property, that is a vetted seller who's actually going to sell.
Yeah.
And so their expectations tend to be more realistic now than some of the off market sellers. So it's a really interesting nuance we're seeing.
Yeah, things are shifting. So you have a competitive advantage because you made it through 2007, 8, and 9 and all of that stuff. You really got to see all this other stuff shift a bunch. How is that helping you make your decisions?
Yeah, it's a really good point. You learn the most in the toughest times. One of the things that's helped with is it's helped teach us what not to buy. I mentioned that first deal was 92 units out in Macon, Georgia. It ended up being a good investment and a profitable one, but man, was that a struggle. It was in a low income neighborhood. It was like a C minus D plus property. Once we got 5, 6 years in, we started looking back over what we acquired and we realized, hey, wait a second. The Class B stuff has earned us just as much or bigger returns with less execution risk and far less headache. And so we said, all right, we're going to stop buying Class C. And I'm not disparaging Class C. Lots of guys specialize that and do really well in it. It's just you have to have the right mentality and systems.
You got to be okay with a lot of hair on the property.
Yeah, or maybe have vertically integrated your construction, companies, or something like some other edge that makes Class C a little bit more palatable. And so we switched to Class B. And then again, looking back at our portfolio to say, okay, what has been the lowest risk? What has been the highest returns and the lowest and the best headache? That helped us shape our screening process. So, we only buy in neighborhoods with certain population growth, certain income, certain crime ratings. We only buy in business friendly states. That's why we're not investing in California. Landlord friendly states.
Landlord friendly state. Yeah.
Yeah,
Jinx.
landlord. Again, I have friends who own rentals in LA that during the COVID period, they
Forget
had
about
rent more 2 years. They couldn't collect rent or evict. Now, fortunately, these guys have been in it for decades. They had the financial wherewithal to weather that storm, but I don't want to have to deal with that, especially if we've got investors that we're serving. So that was some of the things we learned. And then also the biggest takeaway probably was the ability to buy when it was scary. 2009, 10, and 11, everyone was terrified of real estate. It was so hard to raise equity and you couldn't get debt. Forget it. We bought everything cash with equity that we raised.
Are you talking about the big stuff you bought in cash? Like the couple hundred units?
Yeah, because we did. But again, remember pricing we were buying stuff for 10, 15, 20,000 a unit back then. So it wasn't
Crazy.
that hard. Buying cash 150 units A minus in Atlanta today is a little bit different,
A little bit. Yeah.
little bit different proposal.
But you were over that fear because you made it through the other hairy stuff.
Yeah, this is nothing compared to last time. And also it helps us kind of see like, all right, where are the parallels? Where could the opportunities emerge? Where are things different? One big thing that's different, we already talked about, there's a ton of liquidity out there today. Back then there wasn't. There wasn't debt, there wasn't equity. Today, debt isn't crazy like it was 2 years ago, but if you have a stabilized property, you can go get agency loan all day long today. Maybe 65%, not 80, but you can get that debt. You can get a bridge loan. You might pay 9%, but you can still get it. That wasn't the case in 2009. And then equity, again, and I think this is good. Equity is a lot more cautious these days, but a good deal still gets funded because people still need yield, especially in an inflationary environment. So, there are definitely differences, and having been there last time, it helps spot those.
That's really cool to share. It's really cool to hear. Also, being an investor in your fund, it's nice to hear an operator share these types of things. How about the future? Where do you see things going? What do you think? I know you said that we're probably not going to have crazy low rates. I agree, but where do you think they're going to go? How do you see the next 12 months?
Next 12 months to me, if I were to condense it down to one sentence for multifamily, I would say steadily increasing opportunity. Not a tsunami, not a crash. Something that I saw a couple of weeks ago that would be unfathomable for you and I to discuss 2 years ago was we saw a lender approved short sale on an apartment complex. And this was a B asset in a high income market in the Carolinas. And our offer and the other competing buyer, both of the offers were below the balance of the debt. And so the seller picked us, and then the lender actually chose the other buyer because the other buyer was willing to take a bunch of other properties that we didn't want to touch, right? And so the lender's like, we just want to do this in one big swoop. And so we're seeing short sales. But the thing is that is a good sign that the lenders are willing to short sale instead of go through the foreclosure process. And then probably most people listening are well aware there is a large wave of debt maturing in 2024 and
Please talk about that.
2021, if I remember right. 70% of multifamily properties were acquired with 2 to 3 year floating rate bridge debt, which means if it was bought in December of 21, in December of 24, if it was a 3 year, that loan, it becomes due, it matures. And a lot of those were sold, well, oh, hey, you can just extend it. Well, there's stipulations on that. It's not a freebie. The property has to be performing well, it has to pay the interest rates. And a little clause that most of the lenders stuck in there that nobody noticed is, oh, by the way, the property has to qualify on the uncapped payments, even though you're buying a rate cap, right? It's kind of like their get out of jail free card if they don't want to have to work with you anymore. And there's all kinds of situations. But, when you originated that floating rate loan back then, your interest rate might have been 2.5, 3% that your effective rate that you were paying. Well, now it's 7, 8, 9%. And these properties can't pay that. Even if the operator did a great job running the property was never intended to be able to support debt at 9%. Add to that, values are down again 20, 25, 30, maybe 35%. When you're going to refinance, they have two problems. Number one, the property might not appraise enough to get the proper LTV. And then even if it does, the lender is going to say your debt service coverage ratio is not good enough. The property doesn't produce enough net operating income to pay these mortgage. So here's your options. You either pay us off in full or we'll refinance you, but you have to add $8 million to bring the loan balance down so that we have a proper LTV and appropriate mortgage payments. And most sponsors are unable or unwilling to do that. And then sometimes it's throwing good money after bad if you're just kicking the can down the road. And so what this is leading to, and just starting to see it, is truly motivated sellers that have to sell, and they don't necessarily want to. And what that means is we're going to see assets trade that otherwise would probably get held. So high quality assets, high quality locations that have to be sold because the debt is maturing. And it doesn't even mean the asset is distressed.
Right.
It could be a wonderfully operated property, but there's stress on the financial side. So we've got stress, which is financial, distress, which is at the property level. And the majority of the problem is stress on the financial side. So that is a steadily increasing venue of opportunity for the next 18 months. But
Yeah.
again, this is no secret. Most operators out there, funds, there's a few trillion dollars waiting for this to happen. So definitely not a time to sit back and wait, because by the time it becomes obvious,
It's
a
too
lot of
late.
the opportunities is gonna be gone.
Yeah, I'm happy you said that. That's a good caution because I do think you're exactly right. And I read some article that was like, you can't wait. If you wait at all, you'll be passed by, and now's the time. And specifically, the article said something about how this is going to be one of the greatest exchanges of wealth for 2024, 25, because everything that we were just talking about. But you agree with that?
I do. I don't know about the greatest, but it's gonna be significant. When I talk to a lot of people in the industry, it's absolutely true. It's been so hard to get deals the last 5 years, especially if you were a responsible operator, right? It's
Yeah.
been very difficult. And if you're trying to get into the industry, it's been nearly impossible. This is the opportunity that people have been waiting for. I wouldn't say it's going to be easy to get deals, but it's going to get a lot easier than it was the last few years. And if you're looking to get started, there's a lot less competition. A lot of operators are out of business or in hunker down in survival mode. It's time to take advantage of that.
Let me say the opposite side of that. There are investors that have lost their shirt. It sucks. They lost their life savings or and then there's other good investors that were diversified and they still trust in funds. And, there's all these different people that lose some trust and credibility. But I feel like you and I, like you can look under my skirt anytime. I'll show you all my financials. I'll show you everything. I'm like, go for it. Find a hole. If you find one, I'll try to fix it.
Yeah, yeah. Let me know. That's actually doing me a service.
Yeah, that's where I see a lot of just following your point, that's a huge thing to get like fuel behind good operators, take advantage of good opportunities, the world of private equity. No one wants to capitalize on the negative, but real estate is a risk. And there's some funds that took those risks and they ended up in a tough position, or just owners or portfolios. Or one thing I love is the sellers that are over 60 and 70 and their properties put their kids through college and graduate school, and they just don't want anything to do with those properties. There's such a tidal wave of people that are just like, yeah, my kids don't want it, get rid of it. But yeah, lots of opportunity. Thanks for that. Give me some last points and then how someone gets a hold of you and invest in you.
Yeah, last points are ignore the scary headlines. Now's the time to jump. In fact, I would say it's inversely related, right? The more frequent and the scarier the headline, probably the better the opportunity that's coming.
I love that.
A little bit of caution is good. Definitely vet your sponsors, vet your operators. One of the questions people ask when we're doing our onboarding interviews is, what's the question I didn't ask that I should have? And it's like, well, you should have asked me, what's my worst deal and if I ever lost money? Almost anyone who's operated the last 10 years has great stories about how they made 3x or 4x because we were all in a great market. We're really not that much of a bunch of geniuses. We had a great bull market. So ask about what the worst deals were and how those went and what they learned. And I think you'll learn more from that than anything else in your vetting process. And in terms of getting in touch with me, Vantage Point Acquisitions, if you Google Andrew Cushman, I pop up all over the place. The website is vpacq.com. There's a couple of tabs on there to connect with us. I am not a social media guy. I don't dance. I don't make great thumbnail
No
faces.
TikToks?
No TikToks. However, I do post on LinkedIn
Yeah.
pretty regularly, and
Me too. It's my favorite. That's the only one I use.
that's the only one I use. Yeah, my friend David Green, he says you're just a walking LinkedIn. I'm like, okay, I'll take it.
I'll take it. Yeah.
Yeah. So if you comment, and that actually is me posting and responding, not a chat bot. It's not AI. It's not, I'm actually
Yeah.
doing that. So
It's the AC, Andrew Cushman.
it is the real AC. Yeah.
Thank you. Thank you so much. For everyone who's listening, Tejas Gosai gives Andrew a stamp of approval. Please invest in him, follow the story. Andrew, thanks so much for being here.
It was great talking with you, Tejas. Appreciate it.
For sure. Real Estate Investor MBA. Check out our previous podcasts online. There's no .com. It's rei.mba. Thank you.